Think of your credit score as your financial report card. It's a 3-digit number that tells lenders how responsible you are with borrowed money. A good credit score can unlock lower interest rates on loans, better credit card offers, and even more favorable terms on insurance premiums. On the flip side, a low credit score can lead to higher interest rates, making it more expensive to borrow money. Your credit score is based on your credit history, which includes your payment history, outstanding debt, credit utilization, credit history length, and types of credit used. Lenders use this score to assess the risk of lending you money. The higher your score, the lower the risk you pose to lenders. A good credit score is essential for achieving your financial goals. Whether you're buying a home, purchasing a car, or simply applying for a credit card, your credit score plays a crucial role. By understanding how credit scores work, you can take control of your financial well-being. It's never too late to start building a positive credit history. By following the tips outlined in this guide, you can improve your credit score and unlock a world of financial opportunities. Your credit score is calculated using a complex algorithm that considers several factors. Understanding these factors is key to improving your credit worthiness. The most important factor is your payment history, which accounts for about 35% of your score. Make sure to pay all your bills on time, including credit card bills, utilities, and loan payments. The second most important factor is your credit utilization ratio, which makes up around 30% of your score. This ratio measures how much of your available credit you're currently using. Keep your credit utilization low by keeping your balances well below your credit limits. Ideally, aim for a utilization rate of 30% or less. The length of your credit history also plays a role, accounting for about 15% of your score. The longer you've been managing credit responsibly, the better. Avoid closing old credit accounts, even if you don't use them anymore, as this can shorten your credit history. New credit inquiries make up about 10% of your score. Every time you apply for new credit, like a credit card or loan, a hard inquiry is recorded on your credit report. Too many hard inquiries in a short period can hurt your score. Finally, the types of credit you use make up the remaining 10% of your score. Having a mix of credit, such as credit cards, installment loans, and mortgages, can positively impact your score. Improving your credit score takes time and effort, but it's an achievable goal. Start by checking your credit report from all 3 credit bureaus: Equifax, Experian, and TransUnion. You can access your reports for free once a year from each bureau. Review your reports carefully for any errors or inaccuracies and dispute them immediately. Once you have accurate credit reports, focus on building a positive payment history. Set up payment reminders or automatic payments to ensure you never miss a due date. If you're struggling to make payments, contact your creditors immediately to discuss possible options, such as a payment plan or hardship program. Lowering your credit utilization ratio is another effective way to boost your score. Pay down your credit card balances as much as possible, and consider requesting a credit limit increase to improve your utilization ratio. Avoid opening new credit accounts unless absolutely necessary, as this can lead to hard inquiries on your credit report. If you have a limited credit history, consider becoming an authorized user on a responsible friend or family member's credit card. This can help you build credit without having to apply for your own card. Secured credit cards are another option for building credit. These cards require a security deposit, which typically becomes your credit limit. Improving your credit score is just one part of achieving financial wellness. By taking control of your finances, you can create a more secure and prosperous future. Start by creating a budget that tracks your income and expenses. This will help you identify areas where you can save money and reduce unnecessary spending. Build an emergency fund to cover unexpected expenses, such as medical bills or car repairs. Aim for 3 to 6 months' worth of living expenses in your emergency fund. This will prevent you from relying on credit cards or high-interest loans during times of financial stress. Consider working with a financial advisor to develop a personalized financial plan. A financial advisor can help you set realistic financial goals, create a plan to achieve those goals, and provide ongoing support and guidance. Remember, your financial journey is unique. By taking small, consistent steps, you can improve your credit score, build a solid financial foundation, and achieve your financial dreams. Pause 3S. Now that you've taken control of your financial future, let's focus on maintaining your high credit score over time. Consistency is key, and there are several strategies to ensure your credit score stays in top shape. First, always pay your bills on time. Set up automatic payments or reminders to avoid missing due dates. Late payments can significantly impact your credit score, so staying on top of your payment schedule is crucial. Next, keep your credit utilization low. Aim to use no more than 30% of your available credit. This shows lenders that you can manage your credit responsibly without maxing out your credit cards. Regularly monitor your credit report for errors. Mistakes on your credit report can drag down your score. Check your report at least once a year and dispute any inaccuracies you find. Diversify your credit mix. Having a variety of credit types, such as credit cards, installment loans, and retail accounts, can positively influence your credit score. However, only take on new credit if it makes sense for your financial situation. Avoid closing old credit accounts, even if you no longer use them. The length of your credit history is a factor in your credit score, and older accounts can help improve your score over time. Now let's hear from some experts and real-life success stories. Pause 2S. Congratulations on making it this far. You've learned the essentials of managing your credit score. Now, let's dive into advanced credit management techniques that can take your financial health to the next level. First, consider leveraging balance transfer credit cards. These cards often offer low or zero interest rates for an introductory period, allowing you to pay down existing debt more efficiently. However, be mindful of transfer fees and the length of the introductory period. Next, explore the benefits of a secured credit card if you're working to rebuild your credit. Secured cards require a cash deposit, which acts as your credit limit. By using a secured card responsibly, you can demonstrate your ability to manage credit, which can help improve your score over time. Another advanced strategy is to request a credit limit increase on your existing cards. A higher credit limit can lower your credit utilization ratio, potentially boosting your credit score. Be sure to request increases sparingly, and only if you can manage the higher limit responsibly. Additionally, you might want to consider becoming an authorized user on someone else's credit card. If the primary cardholder has a good credit history, this can positively impact your score. Make sure the card issuer reports authorized user activity to the credit bureaus. Finally, if you're struggling with high-interest debt, look into consolidating your debt with a personal loan. This can simplify your payments and potentially lower your interest rate, making it easier to pay off your debt faster. Implementing these advanced techniques requires careful planning and discipline. Always tailor your approach to your unique financial situation and goals. Pause 2S. With these advanced strategies, you're well equipped to navigate the complexities of credit management and continue building a robust financial future. Keep learning, stay disciplined, and watch your credit score soar. Pause 2S. Now that we've covered advanced credit management techniques, it's essential to understand the foundation of your credit health, your credit reports and scores. These reports are detailed summaries of your financial behavior, compiled by credit bureaus. They include information such as your payment history, credit accounts, outstanding debts, and any public records like bankruptcies. Each of the three major credit bureaus, Equifax, Experian, and TransUnion, maintains its own report on you. It's crucial to review these reports regularly to ensure their accuracy. Mistakes can happen, and errors on your credit report can negatively impact your credit score. If you find any discrepancies, you have the right to dispute them with the credit bureau. Your credit score, on the other hand, is a numerical representation of your credit worthiness. The most commonly used scoring model is the FICO score, which ranges from 300 to 850. Your score is determined by factors such as your payment history, amounts owed, length of credit history, new credit, and types of credit used. Understanding your credit report and score can help you make informed financial decisions. For instance, lenders use this information to determine your eligibility for loans and the interest rates you'll be offered. A higher credit score can lead to better financial opportunities, such as lower interest rates and higher credit limits. To maintain a healthy credit score, make sure to pay your bills on time, keep your credit utilization low, and avoid opening too many new credit accounts in a short period. Regularly monitoring your credit reports and scores can help you stay on top of your financial health and address any issues promptly. Pause 2S. By understanding your credit reports and scores, you can take proactive steps to manage your credit effectively. Knowledge is power, and with this information, you're better equipped to make smart financial choices and secure a bright financial future.